Nobody saw it coming. Not the analysts at Goldman Sachs, whose oil market research is read by every major institutional investor in the global energy sector. Not the OPEC watchers at the International Energy Agency, whose specific institutional mandate is to understand and predict exactly the kind of supply decisions that Saudi Arabia just made. Not the trading desks at the major oil commodity houses, whose billions of dollars of exposure to crude markets depend on their ability to anticipate the moves of the world's largest oil exporter before those moves become public. Not the energy ministers of the consuming nations, whose policy frameworks for managing energy security are built on the foundation of modeling Saudi behavior, with the most sophisticated analytical tools available to sovereign governments. Nobody saw it coming. And nobody being caught off guard by a Saudi oil move is itself a significant event, because Saudi Arabia's oil strategy has been one of the most closely watched, most intensively analyzed, most extensively modeled subjects in the global financial and geopolitical research community for decades. The number of analysts, institutions, governments, and trading operations whose specific function includes anticipating exactly what Saudi Arabia just did is extraordinary. The infrastructure of Saudi oil market surveillance is arguably the most extensive dedicated to any single country's policy decisions in any single commodity market in the world. And they were all caught off guard. That fact, the specific surprise that Saudi Arabia has just delivered to the most prepared and most sophisticated community of observers in the global market, is as significant as the content of the surprise itself. It tells you something about the nature of what Saudi Arabia just did, about the specific character of the decision whose announcement caught everyone off guard, about the gap between the analytical frameworks that the global observer community was applying to Saudi behavior and the actual strategic logic that MBS has been following, a logic whose latest expression has once again revealed itself to be operating on a different frequency from the consensus that was unanimously wrong about what was coming. What did Saudi Arabia do? Let's establish that precisely before examining why it caught everyone off guard and what it means for the specific configuration of the global energy market and the broader strategic environment in which that market is operating. Saudi Arabia has announced a surprise production increase, not the modest, graduated, carefully telegraphed adjustment that OPEC Plus production management typically involves, but a significant, unilateral, immediately effective increase in Saudi production output that will add meaningful volumes to the global oil market in the near term without the prior consultation and collective decision-making process that the OPEC Plus framework nominally requires. The scale of the increase, its specific barrel per day magnitude and its timeline for implementation, exceeds what any consensus analyst projection had placed in the probable near-term range. The specific parameters of the announcement have been confirmed through multiple official Saudi channels, verified through Aramco operational communications, and are being processed by every market participant with the urgency of a development that changes the fundamental supply assumptions on which current positions are built. The immediate market reaction has been exactly what an unexpected supply increase of this magnitude produces in a market that was not positioned for it. Oil prices moved sharply, not the orderly adjustment of a market absorbing anticipated news, but the specific dislocated repricing of a market that was caught on the wrong side of a surprise, that had positions calibrated to a Saudi production trajectory that the announcement has just invalidated. The sharp price movement is the market's acknowledgement that the analytical framework it was applying to Saudi behavior was wrong, that the models, however sophisticated, however extensively parameterized, however carefully calibrated to the historical patterns of Saudi OPEC Plus management, were missing something. That something is what this analysis will examine, because understanding what the models missed is the foundation of understanding what MBS is actually doing. Let's start with what the consensus was expecting, because the gap between expectation and reality is where the strategic logic most clearly reveals itself. The consensus expectation among oil market analysts in the period leading up to the Saudi announcement was built on a specific reading of Saudi Arabia's strategic incentives in the current market environment. The reading went like this: Saudi Arabia needs oil revenues to fund Vision 2030. Saudi Arabia has been managing production carefully to maintain prices that support those revenues. The current market environment, with Russian supply disruption adding a supply premium, Iranian uncertainty adding a risk premium, and Gulf crisis tensions adding a geopolitical premium, is creating oil price conditions that are favorable for Saudi revenue without requiring Saudi production increases. Therefore, Saudi Arabia will maintain current production levels and allow the favorable price environment to deliver maximum revenue with minimum production effort. This reading was logical. It was supported by the historical pattern of Saudi production management. It was consistent with the public statements of Saudi officials whose communications had given no indication of a production increase in the immediate pipeline. And it was wrong. The reason it was wrong is the reason that Saudi Arabia's strategic logic has consistently surprised analysts who apply conventional frameworks to an unconventional strategic mind. MBS is not optimizing for the objective function that the models assume he is optimizing for. He is not maximizing short-term revenue within a production management framework. He is executing a multidimensional strategic campaign in which oil production is one of several instruments being deployed toward objectives whose full scope the revenue maximization framework cannot capture. What are the actual objectives that the surprise production increase is serving? Let's trace the logic carefully, because the specific combination of strategic purposes that the move serves simultaneously is the measure of its genius, and the explanation of why the analysts who were focused on any single one of those purposes missed the combination. The first purpose is market share capture at a moment of maximum competitive advantage. The Russian supply disruption documented in previous analyses is removing Russian crude from the Asian markets that have been its primary destination since the European sanctions redirect. The Iranian supply uncertainty is creating additional supply gaps in the markets that have been dependent on Iranian crude through sanctions circumvention channels. The competitive landscape for Saudi Arabia's primary export markets has rarely been more favorable for aggressive market share expansion, and a Saudi production increase deployed into this environment does not simply add supply. It fills the specific gaps that competitors' disruptions have created, displacing the premium pricing that supply scarcity generates with the specific Saudi brand of reliable, scalable, competitively priced supply that long-term relationship deepening requires. Market share capture at scale requires volume. Volume requires production. The surprise production increase is the specific instrument of the market share capture strategy that the favorable competitive landscape has created the conditions for. The second purpose is the Russia pressure dimension, the specific additional financial pressure on the Russian war economy that increased Saudi production volumes add to the already severe pressure from Ukrainian deep strikes on Russian oil infrastructure. The analysis of the Saudi price cut for Asia in the previous story established the specific mechanism through which Saudi competitive pricing pressures Russian crude revenues. The production increase amplifies that pressure through the volume channel. More Saudi crude available in Asian markets creates more competitive pressure on Russian crude pricing, reduces the premium that Russian crude can command even at sanctioned discounts, and further reduces the revenue flowing to the Russian state, whose military machine is simultaneously collapsing at the front. Saudi Arabia increasing production at the moment of Russian front collapse is not a coincidence. It is the specific economic dimension of the pressure being applied to Russia from multiple directions simultaneously. The military pressure of the Ukrainian all-out offensive, the economic pressure of the deep strike campaign on Russian oil infrastructure, and the market pressure of Saudi production increases competing for the Asian market share that Russian crude revenues depend on. The combination is the specific multi-domain pressure whose totality exceeds what any single dimension could produce. The third purpose is the OPEC Plus management dimension, the specific demonstration of Saudi Arabia's willingness to make unilateral decisions within the OPEC Plus framework that serves the same function in the coalition management domain that similar demonstrations have served throughout MBS's OPEC Plus leadership. The UAE's independent production behavior has been a recurring challenge to Saudi coalition management within OPEC Plus. The specific Abu Dhabi pattern of exceeding production quotas and positioning for independent market share that the analysis of MBS's Abu Dhabi confrontation strategy documented. Saudi Arabia making a unilateral production decision of this scale communicates to every OPEC Plus member that the framework's parameters are set in Riyadh, that Saudi Arabia's strategic decisions about production are not constrained by the coalition management process in ways that would allow other members to use that process to limit Saudi freedom of action. This communication is simultaneously a reassertion of Saudi leadership primacy within OPEC Plus, and a specific warning to Abu Dhabi that the space for independent UAE production decisions that diverge from Saudi strategic direction has been further constrained by Saudi Arabia's demonstrated willingness to act unilaterally when its strategic interests require it. The fourth purpose is the Vision 2030 positioning dimension, the specific investment in long-term relationship capital with Asian partners that the production increase, combined with the competitive pricing documented in the previous analysis, is delivering at the moment when those partners' energy security concerns are creating maximum receptivity to exactly this kind of relationship investment. Asian energy importers who are experiencing the supply anxieties of the current crisis environment, the Russian disruption, the Iranian uncertainty, the Gulf escalation, are at maximum receptivity to the specific offer that Saudi Arabia is making with its combination of competitive pricing and increased production availability. The long-term supply contracts that Asian importers are now signing with Saudi Arabia on the basis of the favorable pricing and the demonstrated supply reliability represent exactly the relationship deepening that Vision 2030's international partnership strategy requires as its energy sector foundation. The paradox that analysts focused on short-term revenue are missing is that Saudi Arabia is accepting lower per barrel revenue in the short term, specifically to secure the long-term relationship volume that produces superior total revenue over the strategic time frame that actually matters for Vision 2030's objectives. The revenue maximization framework that the consensus was applying is the wrong time horizon for the objective function that MBS is actually optimizing. Now let's examine why analysts specifically were caught off guard, because the institutional dimension of the surprise is itself analytically significant. The oil analysis community has specific institutional characteristics that make it systematically vulnerable to being surprised by the kind of move Saudi Arabia just made. The community is organized around the analysis of market signals, the specific data that oil markets generate and that models translate into price projections and production expectations. It is very good at processing known variables and historical patterns. It is structurally less equipped to process the specific kind of multidimensional strategic reasoning that produces decisions whose individual market logic appears suboptimal, but whose combined strategic logic is coherent at a level of analysis that market models do not incorporate. The specific analytical failure in this case is the failure to integrate the geopolitical, the financial architecture, and the coalition management dimensions of Saudi oil strategy with the market mechanics dimension that oil analysis focuses on. An analyst who is excellent at modeling Saudi production economics, who understands the marginal cost of Saudi production, the budget break-even price, the historical sensitivity of Saudi production decisions to price levels, will consistently miss the decisions that MBS makes for reasons that those variables do not capture. The history of Saudi oil surprises in the MBS era is a history of this specific failure recurring. The 2019 production cuts that the market didn't anticipate. The 2020 price war, whose initiation and termination both surprised the consensus. The 2022-2023 production management decisions that defied every revenue maximization projection. Each of these surprises shared the same analytical failure, the application of market logic to decisions being made on strategic logic. The reaction from major analytical institutions in the immediate aftermath of the surprise announcement has been the specific combination of revised projections and explanatory retrospective that caught-off-guard analysis always produces. The revised price projections incorporate the additional supply and update the market balance assessments that the production increase changes. The retrospective analysis attempts to construct the explanation that missed the prediction, the specific account of why the decision makes sense in retrospect, that every surprised analyst deploys to demonstrate that the surprise was predictable from evidence that was available but not correctly interpreted. The retrospective is worth examining, because the explanations that analysts are offering for why Saudi Arabia made this move reveal what aspects of MBS's strategy the analytical community is now incorporating that it was previously missing. The explanations that are appearing in the research notes and the market commentaries of the major oil analysis institutions are converging on several themes. The market share capture logic against the backdrop of Russian and Iranian supply disruption is appearing in most accounts. Analysts who missed the prediction are incorporating it into their retrospective explanations with the confidence of people who can see, in retrospect, what they didn't see in prospect. The OPEC Plus management logic is also appearing in most accounts. The Vision 2030 relationship investment logic is appearing in some accounts, particularly those from analysts whose frameworks include the longer-term strategic dimension. What is largely absent from the retrospective accounts is the Russia pressure dimension, the specific connection between Saudi production increases and the financial pressure on the Russian war economy. This absence is telling. It suggests that the analytical community is still not fully integrating the geopolitical dimension of Saudi oil strategy, specifically the specific alignment between Saudi production decisions and the pressure on Russian military sustainability into its modeling of Saudi behavior. That absence is itself a prediction that the next Saudi oil move will again catch analysts off guard if it is executed primarily through the Russia pressure logic that their frameworks are not incorporating. The government energy ministry responses to the Saudi production surprise reveal how differently various national actors are processing the same development. The consuming nation governments, the United States, the European Union, the major Asian importing nations, are processing the production increase primarily through the lens of its beneficial effect on supply availability and price levels. An unexpected Saudi production increase in the current crisis environment is a supply addition that relieves some of the price pressure that crisis-driven supply disruption creates, and consuming nation governments are expressing the specific appreciation of supply availability relief that the announcement warrants. The producing nation governments, particularly Russia and Iran, whose market positions are most directly threatened by Saudi Arabia's aggressive production and pricing moves, are processing the announcement through the specific lens of competitive threat. Russian Energy Ministry officials are assessing the specific impact on Russian crude's competitive position in Asian markets. Iranian officials are assessing the implications for the specific market share that Iranian crude has been maintaining through sanctions circumvention channels that Saudi Arabia's expanded presence in Asian markets is now competing more aggressively for. The Russian assessment is particularly acute because Russian energy revenue is simultaneously under pressure from Ukrainian infrastructure strikes, from the Saudi competitive pricing documented in the previous analysis, and now from the volume addition that makes Saudi crude even more abundant and even more competitive in the markets that Russian crude depends on. The three-way pressure: infrastructure damage reducing Russian production capacity, competitive pricing reducing Russian crude's price realization, and Saudi volume increases reducing Russian market share, is the specific combination whose cumulative financial effect on Russian state revenues is what the inner circles gunning for Putin analysis identified as one of the drivers of elite calculation about the sustainability of the current trajectory. Saudi Arabia's surprise oil move is not an isolated commercial decision. It is the latest expression of a strategy that has been executing consistently across every dimension documented in this analysis series: the oil strategy, the pricing decisions, the OPEC Plus management, the non-dollar financial architecture, the regional security positioning, the Vision 2030 investment in long-term partnerships. Each move serves multiple purposes simultaneously. Each is designed at the intersection of commercial logic, geopolitical strategy, and institutional relationship management in ways that single-dimension analysis consistently misses. The analysts were caught off guard because they were applying single-dimension analysis to multidimensional decisions, because they were optimizing for the wrong objective function, because they were modeling Saudi behavior against historical patterns in an era whose defining characteristic is that MBS is deliberately departing from historical patterns to achieve outcomes that historical patterns never produced. The surprise is the message. Saudi Arabia's ability to consistently surprise the most prepared analytical community in the global energy market is itself a demonstration of the strategic depth of MBS's approach. The specific evidence that his thinking is operating at a level of complexity that the consensus frameworks are not capturing. The markets are now repricing. The positions are being adjusted. The research notes are being revised. And the next Saudi oil move is being anticipated on the basis of the same frameworks that just failed to anticipate this one. Frameworks that will need to be restructured more fundamentally if they are to stop being caught off guard by the specific strategic mind that Saudi Arabia's oil policy now reflects. MBS surprised the analysts. He has done it before. He will do it again. And the consistent pattern of being surprised is itself the data that should prompt the analytical community to ask the specific question whose honest answer would improve their predictions. The question is not what Saudi Arabia's oil production economics predict about its next move. The question is what Saudi Arabia's strategic objectives, the full multidimensional range of them, from Vision 2030 to the Russia pressure campaign to the Asian relationship investment to the non-dollar financial architecture to the OPEC Plus leadership consolidation, require from oil production as an instrument. Ask that question with that scope, and the surprise becomes less surprising. The analysts were caught off guard. Saudi Arabia's strategy is working exactly as designed, and the move that nobody saw coming is the latest chapter in the most consequential strategic transformation in the modern history of Gulf geopolitics. Nobody saw it coming. MBS knew exactly where it was going. Iran believed it controlled one of the most powerful choke points on Earth. For decades, it sat at the edge of the Strait of Hormuz and built an entire national strategy around a single idea: control the passage, control the world's energy, control the world's energy, and you control the decisions of nations. If the strait closes, oil stops. If oil stops, industries slow down. If industries slow down, economies weaken. If economies weaken, governments panic. And when governments panic, they negotiate. That was the logic. That was the leverage. That was the weapon Iran believed it had perfected over 40 years. And for a long time, it worked perfectly. Not because Iran used it, but because it didn't have to. The threat alone was enough. The idea of closing the Strait of Hormuz was more powerful than actually doing it. No country wanted to test that reality. No global power wanted to risk triggering a disruption that could shake the entire world economy, because nearly 20% of global oil supply moves through that narrow corridor. That is not just a statistic. That is the backbone of global energy flow. So the system stayed stable, the balance held, the threat remained theoretical until 2026. Because in 2026, everything changed. The theory was no longer enough. The situation escalated, and for the first time, the possibility of closure became real. And when that moment came, something unexpected happened. The world did not freeze, it adapted. And that single shift changed everything. When tensions escalated and the Strait of Hormuz was effectively disrupted, the immediate impact was massive. Shipping traffic slowed down dramatically. Oil tankers hesitated to enter the region. Insurance premiums skyrocketed. Many routes became too risky to operate. Oil prices surged rapidly. Markets reacted instantly. Fear spread across global financial systems. Governments rushed into emergency meetings. Energy security became the top priority overnight. And one question dominated global discussions. Can the world function without the Strait of Hormuz? At first, the answer seemed obvious. No, because infrastructure takes years to build. Because global supply chains are deeply connected. Because geography cannot be changed overnight. But that assumption did not last long. Because the system did not collapse. It adjusted. It moved. It started searching for alternatives. And one country moved faster than anyone expected. The United Arab Emirates. Instead of reacting with military escalation, the UAE took a completely different approach. It responded with infrastructure. It activated a pipeline, not a new pipeline, not something built in response to the crisis, but something that had been quietly developed years earlier. A pipeline designed specifically for this kind of scenario. This pipeline connects Abu Dhabi's inland oil fields directly to the port of Fujairah, and Fujairah is located on the Gulf of Oman, outside the Strait of Hormuz, outside the choke point. That location is critical, because it allows oil to bypass the strait completely. And the moment the crisis escalated, the UAE pushed the system to its limits. Oil that would normally flow through Hormuz was redirected. Instead of moving through the Persian Gulf, it moved eastward, straight to open waters, straight to international markets. The pipeline carries around 1.5 to 1.8 million barrels per day. That is not enough to replace Hormuz entirely, but it is enough to change the equation. Because for the first time, a major energy exporter proved something important. Hormuz is not the only route, and once that idea becomes reality, everything changes. Because power in geopolitics is not just about control, it is about perception. And the perception of absolute control had just been broken, but the UAE was not alone in this shift. Saudi Arabia moved as well. Its east-west pipeline became a critical part of the global response. This pipeline stretches across the country from the Persian Gulf to the Red Sea, and during the crisis, its capacity usage increased dramatically. Millions of barrels per day were redirected. Oil that would have passed through Hormuz was sent across land instead. Together, these pipelines created something new, not a replacement system, but a backup system, a parallel route, enough to reduce panic, enough to stabilize supply, enough to show that the system can adapt under pressure, and adaptation is the most dangerous thing for any choke point strategy. Because choke points depend on dependency. They depend on the idea that there is no alternative. The moment an alternative appears, even a partial one, the entire strategy starts to weaken. And that is exactly what happened. Iran's leverage was not destroyed overnight, but it was challenged. And once leverage is challenged, it begins to erode. But this is where the situation becomes more complex, because pipelines are not perfect solutions. They have limits. They have capacity constraints. They cannot carry the same volume as global shipping routes. And more importantly, they are fixed targets. Unlike ships that move across oceans, pipelines stay in one place. They can be located, they can be tracked, they can be targeted. That makes them vulnerable. And that vulnerability quickly became part of the equation. Energy infrastructure came under pressure. Facilities faced disruptions. Operations slowed down in key areas. And critics raised an important argument. Replacing one vulnerable system with another does not eliminate risk. It simply changes its form. And that argument is valid. Because even with pipelines operating at full capacity, the global system remained under stress. Supply stayed tight. Prices remained volatile. Uncertainty continued to dominate market behavior. So the Strait of Hormuz did not become irrelevant overnight. It still mattered. It still carried weight. But something deeper had changed, the perception of dependence. Before this crisis, Hormuz was seen as irreplaceable, as a single point of failure that could not be bypassed. Now it was seen differently. Now it was one route among several. Still important, but no longer absolute. And that shift in perception changes behavior. Because geopolitics is not just about physical control. It is about psychological leverage. If countries believe they have no choice, they act cautiously. They avoid confrontation. They maintain balance. But if they believe alternatives exist, even imperfect ones, everything changes. They take stronger positions. They form new alliances. They invest in new infrastructure. And that is exactly what started happening. Energy importers began diversifying their supply routes. New agreements were signed. Emergency investments were approved. Projects that had been delayed for years suddenly became urgent, because the world had learned something important. Dependence is a risk, and reducing that risk became the new priority. Countries that once stayed neutral started shifting their stance. Regional dynamics began to change. and the system started evolving in real time. And that evolution is the real story here. Because even if the Strait of Hormuz fully reopens, the system will not go back to what it was before. The assumption that one narrow waterway can control global energy has been broken. And once that assumption is broken, it cannot be easily restored. The long-term impact of this shift could reshape the entire region. More pipelines will be built. More alternative routes will be developed. More redundancy will be added to the system. And that means less reliance on any single choke point. And less reliance means less leverage. Iran's strategy was built on geography, on positioning, on the belief that location alone could guarantee power. But geography can be bypassed. Infrastructure can expand. Technology can evolve. And when enough pressure is applied, the world adapts faster than expected. That is exactly what happened. The attempt to demonstrate control triggered a response that accelerated independence. The move that was supposed to strengthen leverage may have actually weakened it, and that is where the real strategic shift begins, because once the world starts building around you, your position changes. Slowly at first, then all at once. And Iran is now facing that reality. A reality where its most powerful advantage is no longer unquestioned. A reality where the world is no longer waiting. It is moving. It is building. It is adapting. And once adaptation begins, it does not stop. It accelerates. But what makes this shift even more significant is what it reveals about the limits of power built on geography. Because for decades, Iran's entire strategy depended on one assumption, that the world had no choice. That assumption is now under pressure. And once an assumption like that starts to crack, it does not stop at the surface. It spreads deeper into every layer of the system. Because this is not just about oil flows. This is about decision-making at the highest levels of global power. When the Strait of Hormuz was disrupted, countries were forced to confront a reality they had avoided for decades. What happens if the choke point fails? And more importantly, what happens if it can be bypassed? That question is now shaping long-term strategy. Energy importing nations are no longer thinking in terms of stability. They are thinking in terms of resilience, because stability can be broken. But resilience can absorb shocks, and that shift in thinking is already visible. Countries like China and India, which depend heavily on Gulf energy supplies, are accelerating diversification plans. They are expanding storage capacity. They are securing alternative suppliers. They are investing in infrastructure that reduces reliance on any single route, because the lesson is clear. Dependence creates vulnerability, and vulnerability invites disruption. At the same time, global energy companies are adjusting their strategies. Shipping routes are being reassessed, risk calculations are being updated, insurance models are being rewritten, because the cost of disruption has now been experienced in real time, and once that cost is understood, behavior changes permanently. But there is another layer to this story, a layer that goes beyond economics, a layer that involves politics and alliances, because the response to the crisis was not just technical, it was political. Countries that once maintained careful neutrality are now being pulled into clearer positions. The UAE's decision to activate its bypass pipeline was not just an economic move, it was a strategic signal. A signal that it is willing to operate independently of Iran's influence. And that signal did not go unnoticed. Regional dynamics began to shift almost immediately. Alliances started strengthening. Security cooperation increased. Joint planning discussions intensified. Because the risk was no longer theoretical. It was real. And real risks demand real responses. Saudi Arabia's actions reinforced this shift. By increasing the use of its east-west pipeline, it demonstrated that large-scale redirection is possible. Not perfect, not complete, but possible. And possibility is enough to change strategic thinking. Because once something is proven possible, it becomes a foundation for future expansion. And that is exactly what is happening now. Discussions are already underway about expanding pipeline capacity. New routes are being evaluated. Long-term infrastructure projects are being accelerated. Because the goal is no longer just efficiency. The goal is redundancy. Multiple routes, multiple options, multiple layers of security, and every new layer reduces dependence on the Strait of Hormuz. Every new project weakens its strategic importance. But this transition is not simple. It comes with costs. Building pipelines is expensive. Maintaining them is complex. Protecting them requires constant vigilance. And even then, they remain vulnerable, because fixed infrastructure cannot move. And in a region with ongoing tensions, that matters. Attacks on energy infrastructure highlight this risk clearly. Facilities can be targeted. Supply can be disrupted. Repairs can take time. And during that time, markets react. Prices move. Confidence drops. Uncertainty spreads. So while pipelines provide alternatives, they also introduce new challenges. And managing those challenges requires coordination. Coordination between governments. Coordination between companies. Coordination between allies. Because no single actor can manage this alone. And that is leading to another important shift. Increased international cooperation. Countries that once operated independently are now working together more closely. Information sharing is increasing. Joint security measures are being discussed. Collective responses are being planned because the threat is shared. And shared threats create shared interests. This is how geopolitical landscapes evolve, not through single events, but through reactions to those events. And the reaction to the Hormuz disruption is still unfolding, but its direction is already clear. Less dependence, more diversification, greater resilience. That shift is not temporary, it is structural. Because once systems start adapting, they do not return to their previous state. They evolve, they expand, they reinforce the changes that kept them alive. And that is exactly what is happening now. The Strait of Hormuz is still there. The ships will eventually return, the traffic will recover, but the illusion is gone. The belief that one narrow passage can control the entire global energy system has been broken. And in geopolitics, perception is power. When perception changes, power follows. Iran did not just test its strategy, it exposed its limits. Because a strategy built on control only works as long as that control remains unquestioned. The moment it is challenged, the system begins searching for a way out. And once that search begins, it does not stop. It accelerates. It spreads across industries, across countries, across alliances. Every new pipeline, every new agreement, every new route is part of that acceleration, is part of that shift away from dependence. And that is the real consequence of this moment. Not just disruption, but transformation. Because the world is no longer reacting. It is preparing for a future where no single choke point can hold it hostage. Preparing for a system that is more flexible, more distributed, more resilient. And in that system, leverage changes, power shifts, and strategies that once seemed unbreakable start to fade. Iran built its advantage over decades, carefully, patiently, strategically. But in one moment, by trying to prove that advantage, it triggered the process that could eventually erase it. And that is the paradox of power. The more you try to prove it, the more you risk losing it. The Strait of Hormuz is not gone, but its dominance is no longer absolute. Its control is no longer guaranteed, and its role in global energy is no longer untouchable. The world has seen another way. And once the world sees another way, it never forgets it. This is not the end of the story. This is the beginning of a new phase, a phase where control is replaced by competition, where dependence is replaced by diversification, and where every crisis becomes a catalyst for change. Because in the end, the most powerful force in geopolitics is not control, it is adaptation.